Hello, and welcome to the Cornerstone Wealth 2017 Kickoff to the Markets. I'm Jeff Carbone, Managing Partner at Cornerstone Wealth. And today I'm joined by Brian Needleman, Chief Economist and Senior Partner, and Chris Zaccarelli, our Chief Investment Officer. We truly had a tale of 2 years in 2016. The start of the year was one of recessionary concerns, a slowing global market, a drop in oil, and Brexit. After the June vote, markets initially dropped, but before month's end, we began to see the second tail of the year. It became more centered around growth, the election, and the Federal Reserve. Brian, with all that happened and the ups and downs of 2016, how would you describe the year?
It was a good year. Most all indices finished positive. How we got there is another story. There's a lot going on. Basically, you had the end of 15, the Fed raising rates, which drove our dollar up and our markets down. So we had a correction in the first 6 weeks of the year. We had oil hit down to $26 a barrel, which put a lot of fear in the market. And basically, people thought either oil companies go bankrupt or default in their high-yield bonds. That was a big one. We also had Brexit, which they voted, but it went opposite people thought. They left the union. And then finally, we had an election that was highly heated and segregated. So the thing is that it was a lot of year. But being an economist, I think the biggest one that I saw and that people would look back and see is the fact of how the interest rates affected the market. You know, we started the year at a 209, and by July 8th, we were down to 137 in the 10-year Treasury. And basically, the things that should work in a falling interest rate environment, utilities, consumer staples, real estate, investment-grade bonds, acted just the way they should have. But then from July 8th to the end of the year, interest rates from 137 to 24, which was a short term of high interest rate acceleration. So the things that shouldn't have worked didn't. They sold those off and they bought the interest rate sensitive things going up. And that was growth, small caps, financials, credit sensitive bonds like high yields. And it was really interesting.
And do you expect those things to continue into this year? And if not, what things are you looking for?
I expect volatility to continue. That's never going to stop. But quite frankly, right now we have a very good economy. Probably the best of the last administration is right now. We have consumer confidence at a 15-year high. We have housing at a 10-year high. Basically, we have a 17 million run rate on automobiles. We just came out with consumer credit for November, and it came out at 24.6 billion, and they're anticipating 19 billion. So you can see that the consumer is really stepping up in spending based on that confidence they have. Now that's all going along well, and the underlying economy looks very good. We try to look out next 3 to 6 months, but on top of that, with the new administration policies of repatriating assets, tax cuts, regulatory reform, all those things are positive for the economy. They'll be placed on top of what's already happening. So I think next year should be all right.
Chris, given all we've seen recently, what should investors be focused on now?
Well, I think Brian's really pointed out a lot of the key points, and that's that corporate tax reform, deregulation, and repatriation of assets held overseas are really going to be the key to moving this market higher. Those three pro-growth policies are what investors were looking for at the end of last year, and they bid stocks up accordingly. So some of that good news is priced in. But now, as we come to 2017, that's where the rubber meets the road. We really need to see these policies enacted. So we'll be looking to see whether or not these laws can get through Congress and whether or not the administration focus on doing some of the other things that they said they would do.
And out of the list of issues, which is most important?
Well, definitely corporate tax reform is the most important issue, and it's probably the most challenging. Unlike executive orders or repealing regulations, which can be done unilaterally, passing laws requires working through Congress and compromising in order to get those things achieved. And really, it's through the compromise process that you could see the policies that actually become enacted not necessarily be as strong as what people are expecting to happen. And that's really going to be the key for markets this year. So specifically, if you look at corporate tax rates being lowered, if that comes part and parcel with tax deductibility of interest on corporate bonds being removed, then the impact of that policy is going to be much more watered down than if you had seen the same policy enacted without any restrictions.
Brian, as you know, most of our clients have been with us a long time and are comfortable with our approach to managing their money. But for those that are recently joined us or those who are thinking about working with Cornerstone Wealth, what would you say to them?
Cornerstone is a very holistic approach and a team approach. And basically what we do is we start with the advisor. And the advisor basically figures out where people are, where they're going, what type of risks they need to get there, and which portfolio would be most proper for them. That allows us in money management to focus on macro and microeconomics to attempt to get higher returns with less risk.
Chris, what advice do you have for those people who are wondering when is the right time to get into the market?
Well, it's a great question, and really the crux of the matter is market timing is one of those things that's very difficult to do. Even the most experienced professional investors are constantly surprised by the markets. And although a lot of people think they can do it, it's often really difficult to do in any kind of a consistent basis. A more important approach is to look at your investment goals. So specifically look at your time horizon, your risk tolerance, and your income needs. If you develop a plan that can address those things and you have patience, the rest will take care of itself.
Chris, I want to ask you, where do you see the biggest risk for the remainder of the year?
Sure, well, there's plenty of risks this year, and there are risks every year. So for instance, you have to worry about trade wars breaking out, actual military conflict. But in addition to that, you also have to worry about what's happening with the European Union. Brexit was really an eye-opening affair, which showed that with the UK leaving the European Union, there's that risk that the Union may not stay intact. Additionally, you have to look at China, which is the second largest economy. Their economy has been growing really fast for a long period of time, and now that rate of change is starting to slow down. So if they're able to slow that economy down within an orderly fashion, everything should be fine. But if the economy comes to a screeching halt, you'll see much broader impacts across the world, and the U.S. will not be immune from that.
Brian, I just asked Chris where the greatest risks were. Where do you see the biggest opportunities for 2017?
Well, like I said before, Joe, I think this will be a very good year. But the areas that I find most is really global. The United States, I like mid-cap growth. I think a lot of people are looking at large caps, but it's already happened. A lot of the actions we've talked about are already priced in. Plus, with a growing economy, you're going to have a rising dollar and a headwind for large global companies. Mid-caps are unique because they grow faster than large, but they're more stable than small. The other thing is that I think that on the growth side, growth stocks should outperform in a growing environment. And finally, the repatriation of assets from overseas really creates a great wave of mergers and acquisitions, and mid-caps are in the crosshairs of large companies.
Thank you for joining us today. On behalf of the team at Cornerstone Wealth, we appreciate the trust and confidence you have placed in us. We wish you all good health and prosperity in the year ahead. Thank you.